All right. Hi, I'm Dr. Payne. Just wanted to talk about a little bit of accounting when we start in this module on financial statement analysis. So in order to talk about accounting, I first need to explain a little bit about the basis for accounting, which is the accounting equation. Everything that the company owns, we call assets. All those assets are financed by monies that we receive from either outsiders or insiders. Outsiders' borrowings we call liabilities. Insiders is owner's equity. The money that came from insiders, from contributed from insiders, is called capital. So that's through either putting money into the capital account, placing it into the business, or by purchasing stock directly from the company. That's where we get our capital that goes into the business. The other part of owner's equity is retained earnings. That's everything that the company has earned and has not paid it out to the owners as a dividend, and thus it's retained or it's kept. Retained earnings, that is, therefore, is made up of revenues minus expenses, which is our net income, our earnings for the period, or life to date for the business rather, minus dividend, which is what we have paid out to the owners as a return on their investment. That's the accounting equation. That's the basis for how we account for financial statements in a business. Every publicly traded company must issue at least four basic financial statements: a balance sheet, an income statement, a statement of cash flows, and a statement of retained earnings. The balance sheet is as one point in time, one date. So December 31st, 2000, whatever, 16. Balance sheet. All the assets, the liabilities, and the owner's equity, the balances on that date. The income statement is where we report the revenues and expenses, and it's for a range of dates. So it may be for the month or the quarter or the year ended December 31st. So it's for a range of dates. If we say for the year ended, obviously that's going to be from January to December of that year. Okay, so that's an income statement. So that's all the revenues, which is everything that the business has earned, minus the expenses, which is everything that it cost them to earn that revenue. Then we have the statement of cash flows, and that's basically starting out with the net income and then converting it to cash. What happened to the money? I've had board of directors say, okay, sure, we show a profit on the income statement, but show me the money. And that's how we show the money. Where did the money come from? And what did we do with it? We show our beginning cash and our ending cash. That's statement of cash flows. Then we have the statement of retained earnings. So that shows the change in retained earnings for the period. Beginning retained earnings plus net income less dividends paid equals ending retained earnings. So these are very important financial statements to the business. And then next, I want to go in and look at details in these, because we're going to have to be able to understand the statements so that we can pick out the items that we need in order to work the problems.